Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Microsoft.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So, this is a wild one.
I spent the whole weekend just staring at the charts after this earnings report,
Yeah.
and I honestly feel like I've stepped into the twilight zone.
It does feel that way, doesn't it?
You look at the scoreboard, Microsoft posts what anyone would call a double beat. Smashed revenue, smashed earnings. Champagne cork should be popping. But then the market opens and boom, the stock tanks 6%. It feels completely broken. Is the market broken or are we missing something huge here?
It's so frustrating, especially for retail investors, because you see B and you expect green.
Exactly.
But what you're seeing isn't a broken market. It's a very specific kind of anxiety. We call it the CapEx panic.
CapEx panic?
Yep.
Wall Street is staring at the bill for building out AI, and they're hyperventilating. They're so fixated on the cost, the chips, the data centers, that they're completely missing the bigger picture.
Which is?
That Microsoft has, for all intents and purposes, built a monopoly on the infrastructure of the future.
A monopoly on the future. That's a bold claim. Sounds great, but it also sounds incredibly expensive. And that's really the mission for this deep dive, right?
That's the question.
We have to figure out if this drop is a falling knife we shouldn't touch, or if this is actually the best entry point we're going to see in 2026.
And to answer that, we have to look past the scary spending numbers, which are, they are eye-watering.
Oh, yeah.
And look at what they're actually building. The market thinks they're burning cash, but the data suggests they're building a money-printing machine.
Okay, let's get into the machinery then. Let's start with fundamentals, because the Q2 scoreboard is, on the surface, just incredible.
It's a juggernaut. So the headline numbers. Revenue hit $81.3 billion. Just pause on that. $81 billion in 3 months.
It's wild. That is up 17% year over year. And on the bottom line, EPS hit $4.14, up 24%. Both beat consensus.
Okay, 17% revenue growth. For a startup, that's fine. But for a company the size of Microsoft?
It's virtually unheard of. Usually the law of large numbers kicks in. You just run out of world to sell to.
Right.
But they're doing it. And the engine here, it isn't Windows anymore. It's not Xbox. It's Intelligent Cloud. That segment brought in $32.9 billion.
But the real story is Azure. Right.
The real story, the one number that matters above all else, is Azure. Azure growth accelerated to 39%.
39%.
Yeah.
Okay, but I have to play devil's advocate. We hear AI hype constantly. Is this just companies kicking the tires, CTOs with a budget to burn on a few experiments to look good?
That is the bear case, but the data just doesn't support it. It's not testing anymore. We have a specific detail from the report.
What's that?
Gen AI services within Azure surged 160%.
Whoa. 160.
That is the smoking gun. It proves this is real usage. Companies running real workloads, paying real money, and scaling up fast. The testing phase is over. We are in deployment.
Okay, so the demand is real. The top line is great. But we have to talk about the elephant in the room. Or maybe it's a blue whale.
The CapEx.
The CapEx. $37.5 billion. In a single quarter. That's up 66% year over year.
It is a staggering amount of money.
It's eye-watering. Are they just burning cash to keep up with NVIDIA? It feels like they're just shoveling money into a furnace. At what point is this just reckless?
And that is exactly the fear that drove the stock down 6%. Investors see that $37 billion leaving the building and they flinch. But there's a rebuttal.
Okay.
And it lies in a hidden metric. This spending isn't speculative. It's matched by demand. You have to look at commercial bookings.
Commercial bookings, so that's like future sales. Orders.
Essentially, yes. Commercial bookings grew 230% year over year.
Wait. 230%.
230%. It means customers are signing contracts faster than Microsoft can physically build the data centers.
So let me get this straight. They are selling the capacity before the servers were even plugged in.
Precisely. They are selling out the factory before the foundation is poured. Which brings us to the most important acronym for you today, RPO.
RPO, Remaining Performance Obligation. Break this down for me. Why does this matter so much?
Think of RPO as a guaranteed future paycheck. It's money customers are legally contracted to pay, but it's not on the books as revenue yet.
Got it.
Microsoft's RPO is now $625 billion, up 110%.
$625 billion. That's more than the GDP of Sweden.
It is, and it locks in their income for the next 2.5 years. So loop that back to the spending fear.
Right.
That $37 billion in CapEx isn't a gamble. They're spending that money to fulfill contracts they already have in their pocket.
That completely changes the mental picture. It's not build it and they will come. It's more like a restaurant with a line out the door, people have already paid for dinner, and Microsoft is just frantically buying more tables.
Perfect analogy. And even with all that spending, look at their financial health. They still returned $12.7 billion to shareholders.
Through dividends and buybacks.
Yep, up 32%. Cash flow is growing right alongside CapEx. They're funding this whole build-out and still paying you a dividend.
That's a strong point. But let's talk about the moat. What stops Amazon or Google from undercutting them if the RPO is so big?
The switching costs are getting astronomical. It's all about vertical integration. They own the chip now, the Maya 200. They own the platform with Azure. And crucially, they own the user interface.
With Copilot and Office 365, I think that part is so underrated.
It's the most important part. Once a company integrates Copilot into Excel, into Teams, leaving for AWS is a nightmare. You'd have to retrain your entire workforce. It is incredibly sticky.
So demand is locked in, cash flow is strong, the moat is deep, but the stock's still dropped. We can't ignore that. Let's pivot to the technicals.
It was a harsh reaction for sure.
Walk us through it. The report comes out, stock ticks up after hours to around 483, looks fine. Then, January 29th, the bell rings, and bam, down 6%.
A sharp rejection, a classic gap down, and this is despite the beat.
So how do you read that? Fundamentals are screaming up, but the price is screaming down.
This is what we call technical tension. The business is getting stronger, the stock price is getting weaker, and that usually signals a capital rotation, not a business failure.
Capital rotation. So, fancy talk for people taking profits.
Partly. But it's also big portfolio managers rebalancing. Their risk models see that CapEx number and flash red, so they sell Microsoft, move the cash somewhere safer for a bit.
Okay.
But for a long-term holder, someone looking out 12 to 24 months, this creates what we call an accumulation zone.
A buying opportunity. An accumulation zone.
Basically, the price has disconnected from the fundamental value because of a misunderstanding. That's an opportunity.
And we should probably mention, this didn't happen in a vacuum, right? The whole market was weak that day.
Exactly. The NASDAQ and S&P were both down. There were macro headwinds. It wasn't just a Microsoft disaster. They just got caught in the crossfire.
Okay, so technically we're in a dip. What about the sentiment, the vibe? I looked at the Alpha Vantage score, and it's kind of tepid, mildly bullish to neutral.
It's not screaming buy, is it?
No. And if bookings are up 230%, why is the computer score just,
It's the headlines. Those algorithms scrape news sites, and right now the news is full of words like plunge, drop, tanks.
So the algorithm is reacting to the stock price news, not the business news.
Precisely. It's masking the fact that the human analysts are largely upgrading their models and price targets.
Speaking of news,
Yeah.
there was that deal with a company called Perplexity AI. That felt bigger than the dollar amount suggested.
It is a huge signal, a $750 million deal where Perplexity chose Azure over AWS.
And Perplexity, for people who don't know, they're the AI native cool kids. They live and breathe this stuff.
Exactly. And startups like that traditionally flock to AWS. It's the default. For them to choose Azure validates the tech. It shows Azure is winning over the cutting-edge crowd, not just old-school corporate IT.
Okay, so startups are buying in. Wall Street analysts are holding firm. Some are even pointing to like $630 by 2026.
That's right, which from here implies about a 33% upside.
Not bad for a mega cap. But let's get into the rumor mill, this super catalyst.
The OpenAI IPO.
Tell me about it. 2026, what happens?
Okay, so the rumor is an OpenAI IPO in 2026. And the potential valuation we're hearing is $1 trillion.
Plus. $1 trillion for a company we hadn't even heard of a few years ago.
It sounds insane, but it's possible. And if that happens, it instantly re-rates Microsoft's stake. They own roughly 49% of the for-profit side.
So that value, which is kind of theoretical now, becomes real public market value.
It would validate their entire strategy overnight. That $37 billion in CapEx would look like pocket change. People would look back and say, you spent $30 billion to make $500 billion. Trade of the century.
It completely flips the narrative from spending too much to smartest investor in the room.
Exactly. Which is why focusing on one quarter's CapEx is so short-sighted. You're looking at the price of the lottery ticket, not the size of the jackpot.
Okay, but let's be fair. We can't ignore the risks. Let's hit the bear case. What could actually go wrong here?
The risks are real. And number one is margin compression.
Yeah, I saw that. Cloud gross margins dropped from 70% to 67. 3 points is a big hit in this business.
It is. And the risk is, if that keeps sliding down to 60%, the whole story breaks. Investors won't pay a softer multiple for a hardware-like margin profile.
So is this a slippery slope?
Guidance suggests it stabilizes around 65%. And really, it's a strategic trade-off. They're knowingly taking a margin hit now to capture market share for the next decade.
The Amazon playbook.
It is. Which brings us to the second risk, competitive intensity. You mentioned Amazon. AWS is rumored to be investing $50 billion. Google's spending a ton. Is Microsoft's lead safe?
Yeah, $50 billion from Amazon is not a joke.
It's not. But here's the counter. The installed base advantage. Microsoft 365 commercial seats grew 6%.
That's Word, Excel, the Office suite.
Right. AWS doesn't have an office. They can't just flip a switch and put AI on 1 billion desktops tomorrow. Microsoft can. That distribution power is something money can't easily buy.
That's a great point. It's the difference between building a better engine and owning the entire car dealership. Microsoft owns the dealership.
They control the last mile to the user. That protects them.
So we've hit the growth, the spending, the technicals, the risks. It is time for the verdict. What's the score?
I'm giving it an 8.5 out of 10.
8.5. That's pretty bullish after a drop like that. Give me the elevator pitch.
Microsoft is the AI infrastructure monopoly. They have $625 billion in future revenue locked in. The market punished them for building factories that are already sold out. This 6% drop is a gift for anyone with a multi-year hold.
And what's that time frame? When does this pay off?
You need a multi-year horizon into fiscal 2027. Short term, I expect a relief rally in a couple of months as the CapEx shock wears off. But the real wealth is built by holding through this build-out.
So the final thesis. This is a contrarian entry.
Yes. You buy when the street panics about the bill and you sell when they're celebrating the profits down the road.
It really feels like everyone is focused on the receipt and ignoring what they bought.
That's the perfect way to put it. The market is myopic. They see the cost today, they miss the monopoly tomorrow.
All right, before we go, leave us with one final thought to chew on.
Everyone is worried about the billions Microsoft is spending on chips today. But ask yourself, if OpenAI does IPO in 2026, will anyone remember the CapEx bill? Or just the value of the stake Microsoft owns?
If you found this analysis helpful, please make sure to subscribe, like, and leave a comment below. It really helps the channel. Thanks for listening.